Hi everyone, welcome to the first video of ACCA F8 Audit and Assurance lectures. So right from today, you can expect videos on Saturday, Sunday and Monday for the complete syllabus coverage for the F8 paper. So if you are planning for March 24 exams, then probably I'll be posting one chapter per day. So we will be completing the syllabus by Jan end. Okay, so that it will be helpful for you to prepare for the exams. So in this video, I'll be starting with a brief introduction about the paper and then regarding the exam pattern, then I'll be continuing with chapter 1. Okay, let me share the screen. Okay, so I'll be following Kaplan study text. Okay, it's up to you to use a Kaplan study text or a BPP study text. Okay, now first I'll start with the exam pattern. So this is the 8th paper of ACCA. So this is the skills level paper. This is going to be a paper which you will be writing more of theoretical concepts. You will have to study complete theory here. The exam pattern will be based on two sections. Okay. Section A will be objective test questions. Okay. So objective test questions is where you will be given three case studies. Okay. So three cases will be given, and under each case, you will be given five questions. All these five questions will be objective test questions. You will be given the options out of which you have to choose the correct answer. Now, each question will carry 2 marks, which means for one objective test case, you will be getting 10 marks. Okay. Into three cases, which is going to be 30 marks. This is your section A. Okay. So you'll be given three cases. All are going to be objective test questions. And in each case, you'll be asked for 5 questions, each carrying 2 marks. Okay. So if your answer is correct, you'll get the marks, 2 marks. So it's going to be 3 questions and it's going to be 30 marks. Section B. This is going to be a constructed response. This is going to be a constructed response answers. So you will be asked for 3 questions. The first question will be a 30 marks question. So into one, you'll be asked one 30 marks question. Then you'll be having two 20 marks question, which is going to be 40 marks. So totally it's going to be 70 marks in your section B. So this is the breakup of your exam pattern for F8 paper. Okay. So out of this, you have to score as usual a 50% to pass. Fine. Now let me give short introduction of the paper before getting in depth with chapter 1. Okay. So this is a paper which is going to give you a knowledge, complete knowledge of audit and assurance engagements. Okay. You will be learning from the scratch, from the base. This will give you the base for audit because you don't have any previous papers relating to audit in ACCA. This paper is the first paper where you're going to study audit and assurance from the scratch and in depth. You will be understanding the complete process of audit. So we will be learning what is audit, what is an assurance engagement, and how do you obtain an audit. So after obtaining an audit, you have to accept the audit, right? So let me just put it into short term. What is this audit process? Okay. So basically, we will be obtaining an audit, okay, and we will be accepting the audit. Then we will have to plan for the audit. I'm just telling in short for you to understand what we are going to study in this paper. Okay. So you'll be planning for an audit. Then you will formulate certain strategies. Based on which criteria you will formulate strategies, you will have to analyze what are the risks that could be there in the company in which you're going to audit. So you will have to analyze the risk. Then you're coming out with a plan. Plan is basically you'll be coming up with the timing, scope, and the direction of the audit which you have to do. Okay. Then you will be formulating a strategy towards how to carry out the audit. And then you'll be doing the audit procedures. Finally, you'll be documenting it and you will collect the evidence. So just because I've carried out the audit procedures doesn't mean I can come out with an opinion about what I have audited. So I have to uh, collect audit evidence before concluding my opinion. Then I'll be coming out with my audit opinion. So this will be a completion and review stage. Then finally, I will be reporting. Okay. So this is going to be basically the complete audit process. So this is what we are going to learn in this paper. So not only this complete process in detail we are going to learn, we will also be learning what are the rules and regulations that govern the audit, and we will also be learning code of ethics that has to be followed as an auditor. Okay. So these are the things basically we'll be learning under this F8 paper. Okay, now starting with the chapter 1. One. Okay, so chapter 1 is Introduction to Assurance. Yes. Okay. So now, first of all, with this audit paper, you don't have to mug up or memorize any definitions. You just have to understand what the definition means so that you will get an idea of what we are going to do. Okay. So, what is an assurance? See, the term that you have to understand here before starting with this paper is this assurance engagement. An engagement in which a practitioner obtains sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of a subject matter against criteria. You don't have to memorize this, but we are going to break up this definition and understand word by word what they are actually conveying. Okay, so this is going to be an engagement in which a practitioner, who is going to be a practitioner? See, for example, there is a company. Okay, so this is going to be my client company. For example, I'm going to engage in the audit of financial statements. Okay, so this is my engagement. I'm going to audit the financial statements of a company. This is going to be the client company, right? So if I'm going to audit the financial statements of a company, I am the auditor, right? Then I am called the practitioner. So basically, in order to understand this definition, we need to understand the elements of assurance engagement. So there should be a three-party relationship, which means the first one, practitioner, that I told you, right? So if the engagement is going to be audit of financial statements, then I am the auditor who is going to audit the financial statements, which means I am the practitioner. So what am I going to audit? I'm going to audit the financial statements of a company, that is the client company. They are called the responsible party. Why are they called responsible party? Is because Basically, who will be preparing a financial statement? A company has to prepare the financial statement. I am not the person who's going to prepare the audit financial statements. I'm just going to audit the financial statements and I'm not preparing it. So a company is my client. They are responsible for the preparation of financial statements. So basically, financial statements is the subject matter which I'm going to audit. So this is called a subject matter. Okay. This subject matter is being provided to me, practitioner, by the client company, which is the responsible party. They are the ones who are responsible for providing all the informations and documents that are necessary for me to carry out the audit. Okay. So the financial statements will be the subject matter which I'm going to provide an assurance on. And I am the practitioner, and who is going to provide me all the subject matter informations? The responsible party, that is the client company. Okay. Um, you can also call it as a director for your better understanding. So it's going to be directors are responsible for the preparation of financial statements. Okay. So they are the responsible party and the auditor will be the practitioner. Now, why are we prepared? Why are the financial statements being prepared and why are we auditing the financial statements? Who is actually going to use this audit report? They are called the intended users. Basically, why do we audit the financial statements? You need to understand that. Why do we audit? We are going to report on the truth and fairness of the financial statements. Okay. See, basically, who are the investors for a company? Shareholders. Okay. So, if the shareholders are going to invest in a company and they are appointing the directors on behalf of them in order to run the company. Now, these shareholders will be interested in knowing what is the financial position of the company. Right? So, there is a possibility that the directors could manipulate the financial statements to show a better position because they are the persons who are completely engaged in the day to day running of the business. Now, when they are going to report a manipulated financial statement to the shareholders, it's going to impact them and it's going to impact the economic decisions that the shareholders will make based on the financial statements. So that is the reason why a third party, that is the auditor, will be appointed by the shareholders in order to provide an opinion on the truth and fairness of the financial statements prepared by the directors. Okay, so intended users will basically be the shareholders. Not only shareholders, it can be the government or any other stakeholders also. For example, if it's going to be the employees, they will be interested in knowing the financial position so that, yes, if the company is running good, if it is profitable, they can have their salary hikes. Okay. And if it's going to be a supplier or a lender, for example, if it's a supplier, okay, so they have provided us goods on credit terms. So if only the company is in proper running condition, they will be interested in providing us good credit terms, okay, and they'll be able to continue with us for a long run. That's the reason any stakeholder will be interested in knowing the truth and fairness of the financial statements. Okay, so they are called the intended users. So, three party relationship in the five elements, the first element is the three party relationship, that is a practitioner who is going to audit the financial statements or any subject matter. Okay, and intended user is the shareholder and the stakeholders, basically, who is going to make a decision based on this subject matter. And the responsibility is party would be the party who is responsible for providing us the information for providing an assurance engagement. Okay, for carrying out an assurance engagement. And the second one was the subject matter, whatever I'm going to audit. Okay, against which information I'm going to provide an assurance. Then, for example, I've taken audit of financial statements here, right? So how am I going to audit this financial statements? So the subject matter is financial statements. On what basis or a criteria I'm going to audit this? It will be in many countries it would be IFRS. As of ACCA, we are going to go with the IFRS standards. Okay, so whether the company has prepared the financial statements in accordance with international financial reporting standards, international accounting standards, okay. So, or any particular law and regulations governing in that country, whether all this financial statements completely has been prepared in accordance with that criteria. Okay, suitable criteria. That is the third element. Fourth element is that, so once I have audited, okay, so I have audited the subject matter against the suitable criteria. Now I'm coming up with a conclusion, that is an opinion on financial statements. Can I directly give out an opinion on the financial statements? No, I have to give a proof with the evidence. I have to collect the evidence for what opinion that I'm going to give. Any opinion it might be, but it should be given a proof with appropriate evidence. So this evidence should be sufficient and appropriate. Remember, it should be a sufficient and appropriate evidence. Sufficient means it's going to be with relation to the quantity of evidence obtained. Okay, and appropriateness is going to be with the quality of the evidence obtained. There should not be any compromise with this. We need to obtain evidence in order to provide a basis for whatever opinion or conclusion that we are going to report about the financial statements. That was the fourth element. Finally, so once we have arrived with the opinion and we have collected the evidence, we are going to provide an assurance report. Okay, expressing what is our conclusion regarding the engagement process that we have carried out regarding the subject matter. Okay, so yeah, these are the elements to assurance engagement. Hope the elements were clear for you now. So I had taken the example of audit of financial statements. Now let's go back to this definition again. Now you will understand better. So what we basically did, we were engaged as a practitioner for the audit of financial statements. That was a subject matter. Okay. And what did we do? We collected appropriate audit evidence we performed the audit based on suitable criteria, and we obtained evidence in order to support the conclusion that we reached, right? So that's what will be explained in this definition. An engagement in which a practitioner, that is the auditor, obtains sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence. So basically, why they are giving you this wording, degree of confidence, to the intended users? We are basically providing a report regarding the truth and fairness of the financial statements. Why are we actually giving the report on truth and fairness of the financial statements? That is to protect the interest of the stakeholders, right? So these are the people, they are the intended users who are going to use the financial statements in order to come out with certain economic decisions. So they have to get the appropriate confidence in order to make certain decisions. Thus, our assurance engagement, the report that we are going to provide as a part of this assurance engagement, will enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation and measurement of subject matter, that is financial statements as per our example, against the criteria. Okay. Now, yes. So this is the basic understanding of what an assurance engagement is about. Okay. Now, yes, this was the example I had taken in relation to an audit. I had given you the example. Now, what if it is in relation to a forecast? You have been engaged for providing an assurance engagement relating to a forecast. Okay. So, who will be the practitioner here? Who will be the three-party relationship? What will be the subject matter here? Basically, the subject matter is going to be the forecast, whatever, if it's going to be any kind of a forecast, for example, if it's a cash flow forecast, okay, so that will be the appropriate subject matter here. There it was the financial statements. So financial statements we had audited based on the financial reporting framework, for example, based on the IFRS criteria, okay. Here the forecast will be, normally forecast is based on certain assumptions, right? So based on the assumptions, we are going to forecast. So the criteria would be whether the assumptions made are appropriate, okay, and whether the forecast also made are in line with the assumptions that have been made. So that's what will be the suitable criteria. And who is basically going to be the responsible party here? Again, the directors, and the intended users will also be directors or the provider of finance. Why we think intended user will be a director here? Because he is going to be the responsible party. And why is it again the intended user is also a director? Because forecast is not the final outcome of something that you're going to provide to the shareholders. It is for running of the company. You are going to make a forecast at the beginning of the year or for the upcoming years. So this is for the operations. You're going to make a forecast. So the directors will be interested in knowing whether the assumptions made by them are correct, whether it is an appropriate assumption, and whether the forecast made are appropriate with relation to whatever assumptions they have formed. Okay. Then we are not going to audit the forecast. It's going to be just an assurance engagement. So you're going to provide an assurance. So assurance provider is the practitioner. Now, how do you obtain sufficient appropriate audit evidence? Basically, when it is going to be an audit of financial statements, we will be carrying out appropriate audit procedures. That could be test of controls and substantive procedures, which includes like test of details and analytical procedures. We will be looking at this in detail. Okay. Now, first of all, just in short, understand what it is. Test of controls is relating to the internal controls in the organization. For example, we can take the systems. We are going to learn this internal controls in the later chapter, in the internal controls chapter. So in just short, I'm going to tell you here. So for example, there is a okay purchase system. Okay. So where does this purchase system start? Basically, we are going to make a purchase as an organization. We are operating now. Where does this purchase cycle or the system start? First of all, a purchase requisition will be raised. Then you'll be raising a purchase order. The purchase department will be raising a purchase order. I'll be explaining all the systems in detail when we come to the internal controls chapter. Now, in short, I'm telling you. So this starts from this purchase requisition. Then obtaining the goods, it goes to obtaining the goods, and you will be obtaining an invoice against which you'll be making payment, right? So the payment is also to be recorded. Now, so this is the complete system. I'm just telling in short, okay? So whether there are appropriate controls within this particular system, that's what we are going to test regarding the internal controls, whether there are appropriate controls or there are any risks prevailing within these systems. Okay, that is going to be test of controls. Next, the term you have to understand is substantive procedures. Substantive procedure also we will be carrying out in order to obtain audit evidence. This is going to be directly to detect any material misstatements. Okay. So test of controls and substantive procedures we will be doing as a part of the audit procedures. But when it comes to a forecast, we will not be doing all these procedures. It's not going to engage you with more of audit procedures. We'll be just examining the documents, we'll be making some enquiries, Okay, we are not going to do a test of control. We'll just inquire the management regarding the systems and processes, okay, or whatever assumptions made. Then we will be doing an analytical procedure, not going to be a substantive procedure. It's just going to be an analytical procedure. Yeah. What is analytical procedure? Analytical procedure, this one it's going to actually tell you the plausible relationship between the financial data and the non-financial data. For example, in short, it's going to be calculation of ratios. Just an example, okay? We'll be calculating ratios and then we'll be comparing it with the last year's budget or this year's budget or last year's results, okay? Or with a budget, or we can even compare with the industry standards. So we are going to compare the ratios with the last year's results and budgets or industry standards, and we are going to come out with a conclusion on what is the trend, okay, or any other data. Now that's what small procedure that we will be performing in relation to forecast. Now, what will be the final element? It's going to be the report. As of audit of financial statements is concerned, we will be giving an independent auditor's report. Why is auditor's report called an independent auditor? Normally we call it as an independent auditor because the auditor who is going to engage for the external audit will always be a third party to the client company which we are going to audit. He cannot be a person who is employed within the company, right? So that's the reason he's called a third party. There should not be any connection with the client company. Okay, so it should be an independent auditor. So the report given will be an independent auditor's report. Whereas the forecast is concerned, it will just be an independent assurance report. Okay, we are just going to conclude on whether the assumptions used by the company is appropriate and whether the assumptions have been used appropriately. Okay, so that's just going to be an assurance report. Fine. Hope you're clear till here. Now, um, yes. See, they have given you certain examples of assurance engagements. Okay. There is also one more engagement called the review engagement, which I'll be discussing later in this chapter. First of all, examples of assurance engagement. Yes, we have discussed regarding this audit of financial statements. Then, review of financial statements, systems reliability report, review of internal controls. So, these are the things we'll be discussing in detail when we go with other chapters. Okay. Now, if we are going to be an assurance provider, there are certain rules or principles that have to be followed while carrying out this engagement. The first thing will be you have to comply with ethical requirements. So you have certain code of ethics that are to be followed. For example, there could be some kind of threats arising. We have a separate chapter on this. So I'll be discussing this thing as a complete chapter, maybe as a third or fourth chapter, I'll be discussing this. Okay. We have to comply with those ethical requirements. And the most important thing will be apply professional skepticism and judgment. So, what is this? Um, Basically, as a part of audit, what are we going to do? We are going to provide an opinion, okay, on the financial statements, truth and fairness, right? Sorry. By obtaining the audit evidence. Now, we are going to obtain the audit evidence. Can we rely on this audit evidence? Audit evidence is something you're going to obtain from the client company as a part of the audit process. It can even be a third party obtained audit evidence. But is it possible that you can 100% rely on the audit evidence? No, right? So you need to have a critical assessment carried out for the audit evidence obtained. And how will you carry out this critical assessment? You need to have a questioning mind. You need to be judgmental and you should have a questioning mind, and you should be alert to conditions where there could be some kind of an error or a fraud or any bias that could have impacted the financial statements. Okay. So that is basically called the professional skepticism and judgment. That is, you need to, as an auditor, you're performing the assurance engagement, you need to have an attitude of questioning mind, and that you are alert to any conditions that could have an error, fraud, or bias for the financial statements being prepared. So you're going to carry out a critical assessment of any audit evidence that you have obtained to get a reliability on that. Okay. So that is the most important thing. You have to apply professional skepticism and professional judgment. Then other things will be, you will be performing acceptance and continuance procedures. This I'll be discussing in detail in the next chapter. Okay, when we are planning for the audit, I'll be discussing this completely. You have certain procedures to be followed. When you're getting an audit engagement, you cannot just accept it. You have certain procedures to follow. I'll be discussing that in detail. Then once you have accepted the audit engagement, you will have to sign an audit engagement letter. Okay, so you're going to agree to the terms. The client company and as an auditor, both will be signing an engagement letter. Okay, then you should make sure you comply with quality management standards while carrying out the audit. Then, as we have discussed, we will be planning and performing the engagement. You will be obtaining an evidence. Okay. Now, consider the effect of subsequent events on the subject matter. I'll just tell you in short what is the subsequent events. Okay. For example, financial statements have been prepared for the year ended December 31. Okay. Now, these financial statements are going to be approved on, say, 10th Jan. Now, the financial statements have been prepared for the year ended 31 December. So, the financial statements basically will be from 1 Jan to 31 December. Now, the approval is on 10th Jan of the next year. Then, okay. So, there's going to be 2022, and this is going to be, 2022. This is going to be 2023. Okay. Now, the audit is being carried out and the audit report is being signed on 10 Feb, for example. Okay. Then you have the annual general meeting on, say, 20th Feb. So the financial statements were prepared as of 31 December 2022. Now your annual general meeting is on 20th February 2023. So there is almost 50 days of period after the financial statements have been prepared. What if there are going to be some circumstances which could arise after the financial year end that could have an impact on the financial statements? For example, I'll just give you a small example. If there is going to be a fire in the factory, many goods have been damaged. So this, whether it will have an impact on the financial statements or not, okay, or if there has been some other existence of some conditions that existed during this year, you will be remembering the events after reporting period. If you are a F7 student, you have already completed F7. Okay. So you will be looking at basically what has been the subsequent events that have occurred after the financial statements were prepared till the AGM. Okay. Whether that event could have an impact on the financial statements or not. That's going to be the consideration of effect of subsequent event. This is also yet again a big topic that we'll be discussing in detail. Okay. Then once that's done, we'll be forming a conclusion and we'll be providing the audit report. So here they're coming up with another term, the conclusion expressing either a reasonable assurance or a limited assurance. So that is the next topic that we are going to look at. See, when assurance engagement is concerned, there are two types of assurance engagement. First one is reasonable assurance engagement, And second one is limited assurance engagement. For example, for going with the reasonable assurance and the limited assurance engagement, I'll first discuss the review engagement part of the chapter 1. Okay. So, review engagement is an example of limited assurance, but I'll tell you this in detail um, later. Okay. Now, review engagement, normally certain companies are required to carry out the assurance engagement, that is to carry out an audit. But when there are companies that does not legally require to carry out an audit, they can voluntarily engage themselves in order to carry out a review engagement of the financial statements. So as I told with the forecast example, so it's typically like a review where we are just going to provide analytical procedures. Okay, 1 minute. So this is going to be voluntarily, we are going to engage in the review engagement. Okay, so we will be carrying out analytical procedures, which I explained earlier. And together with the analytical procedures, we'll be carrying out some enquiries. Okay, and then we will be giving out a report. Now, this report is called a negative assurance report. That is, we are going to provide a limited assurance only. Now I'm going back to that topic, reasonable assurance and limited assurance. Now, reasonable assurance is where we will be gathering sufficient appropriate evidence to provide reasonable conclusions. Whereas limited assurance is where we are going to gather evidence, sufficient appropriate evidence, but to provide only a limited conclusion. Because under reasonable assurance, we are going to do test of controls and then substantive procedures. So that's going to be an extensive audit procedure carried out regarding the internal controls of the organization. And then based on that conclusion, we'll be carrying out audit procedures, that is substantive procedures, in order to detect any material misstatements, and then we will be gathering the evidence. So that will be of higher reliability and accuracy rather than just performing some enquiries or analytical procedures. This is not going to give you more of a reliability or accuracy part. Okay, so that's the reason we can just give some limited assurance on this and not a reasonable assurance. So when you are carrying out the test of controls and the audit procedures extensively, you will be able to confirm in all the material aspects regarding the subject matter being audited. Okay, but whereas you are just going to make the analytical procedures and just make some enquiries, you are not going to test the controls there. You are just going to inquire the management regarding the systems and controls. You are not testing the controls. Okay, then there is some kind of um, decisions where the subject matter, you will not be able to give a proper conclusion on that. So basically, when you're not able to give a reasonable assurance on it, you will be just able to give a conclusion which you're going to convey it in a negative word, but this will be in a positive word. Meaning is that basically we carried out the audit this side. Okay, audit of financial statements, which we are going to give a reasonable assurance. So, reasonable assurance is normally going to enhance the confidence, degree of confidence of the intended user. That's what we saw as the definition, right? Now, as there's going to be of a high level of assurance, we will be providing the conclusion or our opinion in a positive way. That from the process of audit that we have performed, we are coming to an opinion or conclusion that the financial statements of a company are true and fair in all material respects, and um, they present. So this is the format in which we will be giving. In our opinion, the financial statements give a true and fair view, and the financial position of, for example, we have taken a company as at December 31 year ended, and of its financial performance and its cash flows for the year ended in accordance with IFRS. So this is the criteria that we have used. Okay. So this is in a positive way. Directly, we are telling that we are providing a reasonable assurance that the financial statements are true and fair. So this could enhance the confidence of the intended user. Therefore, it's called a high level of assurance. But whereas we have just performed analytical procedures and made some enquiries where we cannot enhance the degree of confidence, this is just going to be some kind of a low level of assurance that we can provide. Thus, we cannot directly convey our opinion that yes, it is, we provide a reasonable assurance that it is true and fair. We cannot say so. We can just give a lower level of assurance. Lower level of assurance can be worded only in a negative way and not in a positive way. That is, you're not telling them directly that yes, it is true and fair. Instead, what we will be doing, we'll just be saying we have not found out any circumstances where there could be some errors in the financial statements. This is what in normal terms we are going to do. Okay, I'm just telling in normal terms. I have not found any circumstances as I've performed the assurance engagement. I did not find any circumstances where I can say that yes, the financial statements are materially misstated. So, how are we going to convey in a report? This is how we will be conveying. Nothing has come to our attention that causes to believe that the financial statements are not prepared in all material respects in accordance with the applicable financial reporting framework. So understand my explanation clearly. Okay. So we are saying in the first way, in this reasonable assurance, we told directly, yes, it is true and fair. From whatever procedures I have performed, I am declaring that yes, my opinion is that the financial statements are true and fair. But when it comes to the limited assurance engagement, I cannot directly tell them yes, it is true and fair. That would not be appropriate. I am just telling that from the processes that I have performed, procedures or procedures, review procedures that I have performed, I'm just stating that I have not come to any circumstances where the financial statements could be materially misstated or has not been prepared in accordance with the applicable financial reporting framework. Okay. So this is the difference between the limited assurance engagement and the reasonable assurance engagement. Okay. So basically, as an example, reasonable assurance could be for audit and this could be for review engagements. Okay. Now, before going on with external audit engagements, I want you to understand two things. That is internal audit, the difference between an internal audit and an external audit, in short. So basically, internal audit is where you're going to assess and report on the internal controls in the systems. For example, I told the purchase system, right? So, for example, if there are some systems and controls within the organization, there will definitely be. So, on this, we are going to assess and report on the practices and processes of these systems and controls. That is the internal controls. So, this can be carried out even by an employee within employed within the organization. An auditor can be employed within the organization. It is not necessarily that it should be a third party to the organization. Okay. And this is normally carried out throughout the year. We'll be learning internal controls and internal audit in depth in the internal controls chapter. Just understand the difference, basic difference. External audit is where you are going to provide the assurance on the accuracy and reliability of the financial statements of the organization. So that is the reason why the financial this is going to be carried out by a third party to the organization. I discussed with you regarding the need for an audit, right? Because shareholders are the investors, directors are the persons who are running the organization. So basically, directors will be preparing the financial statement. Now, we have to assess the reliability of this financial statement being prepared by the directors because there is a chance of manipulation by the directors, right? So, in order to enhance the reliability and accuracy of the financial statements, the shareholders will appoint a third party as an external auditor, because they should not have any connection with the company. Only then the audit report could be an independent audit report, right? So this will be carried out by a third party and on an annual basis. Fine. So this is the basic difference that you have to know between internal audit and an external audit. Now, the purpose of an external audit engagement. Okay. Normally, this audit engagement, as I told, it's a reasonable assurance. Now, giving you an introduction of the international standards on auditing. Okay, this is called international standards on auditing. Okay, so basically, this ISAs, we will be using these ISAs in order to do the external audit engagements, right? Now, these are the rules that are going to govern, like some IFRS for the accounting standards, ISAs will be used for international standards on auditing. ISA 200, this is going to state out the overall objectives of the independent auditor and the conduct of an audit in accordance with the international standards on auditing. So basically, this is the audit. Okay, this is the ISA. Okay, ISA 200. This purpose of this ISA 200 is to enhance the degree of confidence of the intended users of the financial statements, right? So basically, what we were discussing so far, we are going to provide an opinion on the truth and fairness of the financial statements, right? And I also told based on certain criterias, like whether it has been prepared based on the IFRS criteria, financial reporting framework. Yes, this is going to be governed by this ISA 200. Okay. So that is the purpose of having ISA 200. Now, uh, what are the objectives of the auditor? So, as we have been discussing, we as an auditor are going to provide the reasonable assurance. See, certain terms, this chapter is completely making you understand certain terms. Okay. So, these are the terms you'll be using it for the complete syllabus of AA hereafter. Now, the objectives of the auditor is to provide a reasonable assurance. What is the assurance about? Whether the financial statements are out of any errors or any misstatements or any frauds. Okay. Then, once we are going to provide a reasonable assurance, then what are we going to express? We will be expressing our opinion. So, what is this opinion about? This opinion will be about whether the subject matter, that is the financial statements, have been prepared against the appropriate criteria, that is financial reporting framework for this example. Okay, then we will be reporting on the financial statements and communicate as required by the ISAs in accordance with the auditor's findings. Okay, then yes, we have discussed the need for external auditor. Now, as we have different kinds of benefits for as a part of carrying out an audit, we have different kinds of benefits, like you can enhance the credibility of financial statements, you can identify the deficiencies in the internal control system, and that can be highlighted. Okay, there are certain benefits as well as limitations to the audit. Limitations of the audit, the basic thing that you have to understand is that we are going to provide only a reasonable assurance. Why is this a limitation? We are not providing an absolute assurance. What is an absolute assurance? Absolute assurance is where you are telling, yes, 100% the financial statements that I've audited is 100% true and fair, and it is 100% free from any errors and material misstatements. That is called absolute assurance. Can we conclude and give an absolute assurance? No, we will not be able to provide an absolute assurance. The reason is that Basically, in normal terms, if you understand, audit we will be carrying out on a sample basis. First of all, if I'm going for an audit, okay. So if there are 1,000 invoices that have been given for an audit, I cannot carry out my audit procedures on all the 1,000 invoices. Okay, I'll just be picking out sample of 40, for example. 40 samples I'll be picking out of 1,000, and then I'll be performing my audit procedures on this 40 samples only. So out of 1,000, I'm just picking out 40 samples and performing an audit. And out of this, I'm coming to an opinion that yes, the financial statements are free from material misstatements, errors, and fraud. So they are true and fair. Would it state 100% assurance? Definitely no, because I've not audited the 100% of invoices. I've just done an audit for 40 samples. So I cannot give an absolute assurance for 100%. It's just going to be a reasonable assurance that the financial statements are true and fair. Okay. Then other reasons where you can say that limitations could exist is that the nature of financial reporting. There could be some kind of management judgments, and that judgments could be subject to some bias. And we are not actually preparing the financial statements. It is prepared by the management. So there is a problem that there could be some incomplete or falsified documents that are being provided by the client. And if there are some kind of timing differences, the relevance of the information could diminish. If some time passes over when we are getting the information, then the relevance of those information could have diminished, right? So that is the timeliness of financial reporting. So these can all be the reasons why I cannot provide 100% guarantee of the accuracy and reliability of the financial statements, right? Now, as certain limitations are there, so as I told, we cannot provide an absolute assurance. There arises a expectation gap. So, what is an expectation gap? Some users would assume that yes, auditors are going to audit the financial statements. So it means that yes, they will give an absolute assurance, they will give an 100% assurance on the financial statements, which is not true. We cannot give an 100% assurance. We are just giving a reasonable assurance. So their expectation was absolute assurance, but we are giving only reasonable assurance. So that is the expectation gap that arises. Okay. This expectation gap can we can get these examples. Okay, they think all the transactions and balances are being tested. That's what I told. We are just doing it on a sample basis. Another thing is that they think we are preparing the financial statements, which is not at all true. We are not responsible for preparing the financial statements. Preparation of financial statements is the responsibility of the director and the management. We are going to audit the financial statements. We are not preparing the financial statements. Okay. So, as we have not prepared the financial statements, we cannot give 100% assurance on it. We are just going to audit the financial statements. So, these are all the reasons why there could arise an expectation gap. They think it's an absolute assurance, but we are providing a reasonable assurance, which creates the expectation gap. Right? Then yeah, that's the end of this chapter, but there are few terms that we have to understand. Incorporation, okay, before winding up the chapter, um, incorporation. So you would have learned different business like sole traders and partnership in your schools. Okay, now we are coming up with one more term you have to understand, one more business, that is limited companies. Limited companies are where your ownership and the business are separate. This is to provide some kind of protection to the investors. So, if the investors are going to invest, they are not responsible for any debts arising in the company. That is why the business ownership and the ownership and operations or running of the business are separate. So that's where limited company comes into existence, and the creation of a limited company will be called as incorporation. Okay, so this is going to provide a distinction between the owners and the business itself. Okay, the owner is separate from the business. When the owner is separate from the business, who runs the business? The managers will be running the business. Managers and directors are being appointed to run the business. Fine. Now, when there is a problem with this, there arises a conflict of interest. What is this conflict of interest? See, the ownership and the operations of the business are separate, right? Now, operations and the running of the business are done by the managers and the directors. Shareholders are the investors and who are the owners of the business. Now, they will have different interest. For example, shareholders will be interested in increasing the shareholder value by increasing the profitability of the company. Whereas that could have a conflict of the interest of the directors or the management, because directors and management will be interested in increasing their salaries. They would want more bonuses and some employment benefits. They will be more interested in getting these, maximizing their own wealth. At that time, what happens? The company's profitability might go down because you are going to provide higher salary, you're going to provide higher bonuses. Okay, at that time, the company's profitability would go down, which is against the interest of the shareholders, right? So, in order to cope up with this is the conflict of interest. In order to cope up with this, we are coming up with the legal requirement in order to legal requirement for the financial statements to be produced by the directors, and it allows the shareholders to assess the management's performance. Okay. Now, other few terms that you have to understand before going to the other chapters are, first one is agency. Okay, agency is where principal, that is one party is called a principal and the other party is called the agent. Principal is the person who is going to engage you to perform a particular task on behalf of them. So, for example, if it's a company, shareholders are called the principals. They are going to appoint directors in order to run the company. So these directors will be called the agents. So shareholders are called the principals because they are appointing directors who are the agents who are going to run the company on behalf of the shareholders. Right? So this is called agency. Now, when these directors are being appointed in order to run the company, they are in a position of power and to account for the actions that they take. That's called accountability. Now they are going to run the business. They are in the position of power where they can be held responsible for any actions if the directors are being taken. They are in a position where they can be held responsible for their actions. Okay, so they are accountable to the shareholders for all the actions that they have taken. This is called accountability. We will be studying further about this in the corporate governance section of this paper also. Okay. And they are also called stewards. Stewardship is the responsibility to take good care of the resources. This is basically uh, like a fiduciary relationship. The directors are being appointed by the shareholders in good faith, okay, in order to perform the task on behalf of the shareholders. So that's where they are being appointed as stewards. So directors are basically the stewards of the company, and as I told, shareholders are the principal and they appoint directors, they are the agents. Fine. So that's the end of this chapter 1. I'll be posting the second chapter by probably by tomorrow. Okay. So if you have any doubts, you can share this video with your friends and prepare well for the March 24 exams. I'll be completely posting the lectures, and you can share it with your friends and subscribe to the channel so that you get the notification of all the videos that I'm uploading, all the lectures. Okay. Um, yeah, meet you in the second lecture. Thank you. And if you have any doubts, or if you want me to specifically discuss any other topic from this chapter, then you can post it in the comment section. I'll look forward and try to discuss those topics as well. Okay. Thank you.